Right, guys, finally got some time to actually work on the course. And before deep diving into ICT, I wanted to give you guys a little bit of introduction to trading. What is trading? How does it work? And how can we do it? What do we need to perform trading? And all those things in this first lecture, which is Introduction to Trading. This would be publicly available on my YouTube channel. I'll make a whole separate section for this and post it there. Uh, as for the PDFs, I will post them as well. So let's talk about trading a little bit. Trading is just a simple act of buying and selling in hopes of making a profit. That's as simple as it gets. Of course, you can have a loss in trading as well, but the whole idea of trading is to you want to buy something and you later want to sell it in a profit. And if you want to sell, if you already bought something, you want to sell it in a profit. So something like that. And we take advantage of the price movements in market, which can be short term and long term. For example, if you want to sell milk, right? You bought it for $3, you want to sell it for $4, you make $1 profit. And of course, trading can be done in different markets like stocks, forex, future, crypto, options, and commodities. A lot of options, but we'll narrow it down to what I trade. However, we'll touch on all of these a little bit. So, types of market in trading. The four major types, which I learned along the way, were stocks, currencies, commodities, and cryptos. I want you to understand here is stocks are the companies who have different values like Apple, Tesla, Google. They have public stocks that you can buy online with help of a broker. Currencies are like dollars, euro, yen, Australian dollar, and their pairs like USD, euro pair, or yen USD pair. They have different pairs. These are currency markets. Then we have commodities markets, which can be a gold, silver, oil, tea, whichever commodity that is being traded throughout the world. And crypto came out recently after 2010, is a digital currency, can be Bitcoin, Ethereum, XRP, which are the most famous ones. So these are the four types of common markets that people trade in. Let's look at examples of trading, like how people trade. And you don't need to overwhelm yourself, just understand what I'm telling you right here, and then we will deep down in each of the topic later. So people can trade as a day trader, they can trade as a swing trader, a scalp trader, and position trader. And I added a few little examples of them here. As what is a day trader? A day trader is someone who do trading, buying and selling within the same day. So it can be a short position like an hour or 4 hours long, anything that is done during that market day. And then there is a swing trader, which can hold positions throughout the days or weeks. Like for example, on Monday I saw that the chart shows me that we are going to go down for the upcoming week or month. What I would do is I would open a short position, I will sell it, and then wait for a few weeks until we reach at that point and then buy it back. Then there are scalp traders. Scalp is pretty quick. It's like within seconds or minutes. Like for example, you open a trade at 10 a.m. and then you closed it at 10:05 a.m. Something like that. They're pretty quick. They're even quicker than that. I don't do scalp trading, so that's something that anxiety related. And then there's position trading. Not much of a fan of position trading. I like to be a day trader. I like to go in and out of the market within a few minutes or hours, like 30 minutes at max, 1 hour. And while in position trading, you wait for fundamentals. Like for example, Apple has their earnings coming in, and you want to buy Apple stock, but you have to put a long position or a short position based on the fundamentals. Let's say you anticipate that Apple will show more earnings in their new release, right? And then what you would do is you will buy a lot of stocks of Apple, and that's position trading. And then you'll wait for the news to come out, and the stock will go up or down based on that news, and you will have profit or loss. So that's position trading. Now, one of the biggest questions that come up from people that want to trade is, say, how to trade. Okay, so to trade in these markets, you need to know, you need to have a medium of an agency, an institute, or people, banks that actually trade these markets. So you need a piece of it. And how you can get into the market is through a broker. What is a broker? A broker is someone who just holds your capital and opens your position wherever you want in the market. So let's suppose you want to trade through a broker. In this one, you give the money to that broker and they give access to the market, like the future exchange, CME, ICE, etc. And not, I only trade on CME because I trade futures, so that's the Central Chicago merchandise something. But to get access to that, we need brokers. So we deposit money into these brokers, and then we have different examples like Interactive Broker, Trade, TD Emirates, Ninja Trader, Trade Station, pretty famous, all of them. There is another one called Amp Trader, which is pretty beginner friendly, and I'm planning to open my account there. So as you can see, pros, you can keep 100% of your profit. You have full control over your trading. And the cons are, the losses are also yours. You require higher starting capital, and you need to buy your own data feed. What is a data feed? Like, for example, if you want to trade NASDAQ, which is one of the futures market, is that you need live data. So if you open a position, you want to see it live as to what it is doing, so you can open a position based on that. But if you don't have your own data feed, you will be delayed for 10 to 15 minutes based on the platform that you're using. We'll talk about platform later in the video. Okay, there is another way to trade is through a prop firm. A prop firm has their own capital, so you don't put in your money, but they have different challenges that you have to pass. Of course, you have to put in a little bit of money, like of $100, $50, $150, depending on the firm, and then you have to pass their challenge using a demo account. When you pass their challenge, they give you a live account, and live account, you have to make the profit again. Some prop firms have their activation fees. Like, for example, if you go to Apex, you bought an account for $100, and if you pass the challenge, you have to pay $150 again to get a live account where you will trade again, and then get a payout. And that payout would be split like 70-30, 80-20, 90-10 based on each prop firm. And the examples are Tradify, Apex, Top Steps, all of which I have tried. I have been trading Apex and Tradify. I used to trade Top Step as well, but all of them I like Tradify more. Pros: low personal capital needed. Of course, risk is mostly on the firm, not you. The cons are is that profit is shared, as I mentioned before, and the rules are pretty hectic. If you know how to trade on prop firm, you will be amazing on your own capital, because these prop firms have very hectic rules, like a daily loss limit. You cannot lose as much money as you can on your own broker account. There is a drawdown thing. We will touch more on drawdown, but basically it means that you cannot go down a certain amount of money in the account. There are certain sizes that you can take, like how many contracts you can take on, and they're all strict, like you have to follow them. Otherwise your account will be banned and you would have to buy another account. So the big question, how does it work actually? So in trading, you can make money either going short or going long. What is short? Short is that when you anticipate that the market is going to dump or fall down, you open a short position that this market will go from 100 to 90. And when it goes from 100 to 90, you buy back the contract and keep the $10 difference profit to yourself. And what is long? Long is just when you anticipate that the market will go up. So for example, the market is at 90 and you anticipate it going up. So you buy at 90 and sell at 100, you keep the $10 profit or 10% of profit in that position. So as you can see, when you sell, you can either lose or make profit. So when you sell, you have to buy back profit or buy back the loss. It's the same way. And when you buy, you have to sell the profit or sell in loss. So that's the gist of it. While trading futures, especially crypto, commodities, what the good thing about leverage is that you actually cannot buy the whole contract. For example, NASDAQ is $20,000 at the moment, let's suppose, and you want to trade one contract. Now, the actual amount, you don't have it. You have like $5,000 in your account, but the contract is 20,000, so you can't actually buy it. Now, here is what leverage is used for. So what you do is you can open one contract of NASDAQ with 20% of the money. 2% of the money, actually, not 20%. So you would require somewhere around $500 to open one contract on NASDAQ. And that is what the diagram explains. I got this diagram from IG.com, and it tells you about the total exposure position, the capital required to open the position. So the blue area is what the broker gives you so that you can open a position, and the red area is what you give to the broker to open the position. Let's take an example for the leverage long. What happens here is, let's suppose you entered at 884 on NASDAQ. We're just giving an example on this. NASDAQ is obviously around 24,000 something, but we have to take a simple example. So in NASDAQ future leverage, right, we have a contract size which gives us 20 points, $20 per point. And the margin required is 0.02%, which is a 20 to 1 leverage, which I explained earlier. And we are going long. We anticipate that NASDAQ will go up. So we enter at 884 and exit at 904, which is 20 points, and our profit is $400. Now, the broker also has its fee that it takes from you. It can be $5 and $20 depending on the broker that you're using. So out of that, you keep all the profit. Or if you're trading prop from, of course, 80%, 90%, or 70% of the profit. So you buy at 884. After 20 points, you sell at 904. Each point is $20. You gain $400. NASDAQ short example. You enter at 884 and exit at 872, 12 points. Each point is $20 and you make $240 by having a margin of 2%. Okay. So now you understand what are the trading markets and how we can make money trading, and how we can anticipate that the price will go up or down. Actually, we haven't talked about that, how we can anticipate that. That's mostly of technical analysis, but you get the gist of it. We have different markets, we have different brokers we can use to trade. But now to actually perform the trading, you have to have a trading platform which is connected to your prop firm or your broker. And most famously known trading platforms are TradingView, TradeAway, and NinjaTrader. In my personal experience, I've only used TradeAway and TradingView, which I think is enough for most of the people. Not saying for everyone, but for me, it's enough. I've been trading prop firms, and what prop firms do is they give you access to the data feed and all that, and give you TradeAway accounts. And you can connect that TradeAway to your TradingView if you're more comfortable on TradingView. So TradingView gives you all the necessary stuff For technical analysis, you can do chartings on it, and you can connect it to your broker and take live trades on TradingView. And if you don't like TradingView, you can just directly trade on TradeAway. Okay, and let's suppose you don't even like TradeAway, then you can go to your broker, and they might have their own charting tools that you can use to trade. Okay, now we know what is trading, what are the trading markets, how does trading work, what are the brokers, what is a trading platform. Now we just deep dive into how a chart works. A chart consists of candlesticks. Okay, it can be a line chart, but most of the people trade candlesticks. A candlestick shows us what the price did at a certain point in time. Okay, so when the price goes up, we call it a bullish candle, and when the price goes down, we call it a bearish candle. So for this example, bullish candle, if you look at the green candle over here, is a bullish candle. What happens is, at a certain point in time, let's suppose at 10 a.m., we created a new candle. We went down, we made a low, and then we move up, made a high, and at 11 we closed, and then we move on to create a new candle, which can be either bullish or bearish. So this whole candle displays a time frame. A time frame can be 1 minute, 5 minute, 15 minute, 1 hour, and whichever time frame you are on, this candle will represent that time. So for example, you say you're looking at a 15-minute candle, right? 15-minute time frame. So each candle will be 15 minutes. If this candle opens at 10 a.m., it will close at 10:15, and a new candle will open at 10:15. 0.01 second, 0.1 second, 1 second. If it is a 1 minute candle, it will open at 10 a.m., close at 10:01. If it is a 5 minute candle, it will open at 10 a.m., close at 10:05. Based on that, the chart slightly changes the frequency of candles that you see. For the more time frame, the higher time frame it is, the less candles. The lower time frame it is, the more candles. So it's like precision kind of thing. Like the lower time frame you go, you get more precise. Same thing for the bearish candle. You open, you make a small high, you go down, make a low and close. So at 10 a.m. this opened, the price went down a few points, and at 10:01 a.m. it closed, and then that's a 1 minute candle, a bearish candle. So what this actually means is that at 10 a.m. Nasdaq was at 24,000, let's suppose, and we take an example of 1 hour candle. So at 11 a.m. the Nasdaq closed higher than the previous price. It would be, let's suppose, 24,100. And during that 1 hour, it also made a low and a high. So what happened is at 10 a.m. it opened, it made a low, let's suppose 23,900, went back up, up, 24,200, closed back down, 24,150. In that 1 hour, this happened. This gave us a gist of what price did in that 1 hour. Same thing for the bearish candle. It opened, made a high, made a low, and closed. So this is how a candlestick works. Now, if you understand how a candlestick works, you can jump to a chart and see what is happening on a chart. So I added an example of a chart over here, which is a 1 minute chart. And the thing that I explained to you is a bullish and a bearish candle. Now here I look at bearish candles as black candles, so you can change its color, and we'll talk about it later on how to customize all of this according to your liking. So if you look at a chart, the chart gives us the price of a market. It can be stock, commodity, futures, anything. It gives us a price of that market at a certain point in time. Like for example, at 4 p.m. the price went to 24,095, right? At 3:45 p.m. the price was at 24,090. Now somewhere between 3:45 and 4 it was at 24,135. So if you look at the chart with respect to time and price, it will tell you at which time the price was at what point. This is how you look at it. So here you can see the price went up, making all these bullish candles. It went down, making a bearish candle, went up, making all these bullish candle, and each candle is 1 minute. After 1 minute, we made a new candle. After another minute, we made a new candle. After another minute, we made a new candle. And another minute, we made another candle. So how many candles are these? 1, 2, 3, 4, 5. So if we were looking at a 5-minute chart, this would be just one candle, a bullish green 5-minute candle. This is how you look at the chart. So we'll talk about how you can further clarify all these concepts, but this is just an introduction, so we'll talk about it later. Now, this concludes my lecture on introduction to trading. Keep in mind that I, of course, cannot really go too much deep in all of these things. And this is just to give you an idea if you want to start trading, because the information that I gave you is the information you need, nothing more than that or nothing less. We talked about trading types, different types of trading. We talked about different markets. We talked about different brokers and platforms. And I also give you an idea of how a candle look like and how does a lot of candles make a chart. Thank you so much for watching. This is the end of the lecture, and hopefully I'll post new lectures every week. I actually have made the PDFs for upcoming lectures, a few of them, but I have to still work on the videos. So see you then.